Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. We're going to do a podcast today, but today is also about celebration because we're now celebrating our 50th podcast. And that goes without saying. It takes a lot of work. It takes a lot of motivation. It takes dedication to be able to come to all of you every single week and bring information and education that is going to make your lives a lot better. So we're very proud here at Cambridge of the fact that we're one of the very few firms that actually start a podcast channel and is able to keep it going. There are many people out there in the marketplace that start doing podcasts, and after they do 5, 6, 7, maybe 10, 15 at the very most, they feel that it takes a lot of work, it takes a lot of preparation, and the fact that they have to do it every week, then they just pretty much quit. We don't do that at Cambridge, so I'm excited. I want to thank you all for being loyal listeners to everything that we discuss every week. So let's get going. Again, I'm excited. Bert Salazar here again. Today we're going to be talking about a topic that comes to mind just about 3-4 times a week, and sometimes even on a regular basis, on a daily basis. Obviously, we do have a lot of clients here at Cambridge, and many of our clients are calling us on a regular basis to try to figure out the mortgage dilemma. They may be thinking about buying a piece of property, a building, if it's a business property or whatever that may be, and they need to make a decision whether to purchase a 15-year mortgage or a 30-year mortgage. So today I want to have some discussions along those lines. Now, when you're trying to make a decision regarding a 15-year mortgage and a 30-year mortgage, and we're not going to be discussing interest-only mortgages or anything like that. But when you're trying to make that decision between a 15 and a 30, intuitively, it seems fairly easy until you start to apply economic principles. Because once you start to apply economic principles to your decision-making process, then obviously you have to start thinking outside of the box, and you got to start taking things into consideration that perhaps you had never taken a look at prior to listening to this podcast. Now, many years ago, President Donald Trump wrote a book in which he said something that was very, very interesting. He said, if you owe a bank $1 million, obviously you have a problem. If you owe a bank $100 million, they have the problem. So again, when it comes to mortgage decision making, it's very critical to understand the rules of the game and the rules of engagement and how each side of the equation actually benefits from making the right decision at the right time. Now, in deciding whether to choose a 15-year or 30-year mortgage, it's just like trying to figure out, what's better, a hammer or a screwdriver? And the answer, it's always, it depends. And obviously, we're going to be looking at some of the issues that need to be considered prior to making that decision. But in life, like in everything else, it pretty much depends on what it is that you're trying to do. Now, if you want to nail a nail to a wall, obviously a hammer is going to do the best job for you. And the same thing, if you want to put a screw in a piece of wood, a screwdriver is going to do the work. Now, can you take a hammer and try to put a screw into a piece of wood? I guess you could. Now, it's not going to look very pretty, but it might do the job at the end of the day. But for most of us, you want to use the right tools, just like if you were going to play golf. You're not going to play with just one club, depending on the situation, depending on where you're at, on whether you're in the green or you're in the grass. depending if you're in the sand, you're going to bring out the club that is going to be the most suitable for you at that point in time. Now, what are some of the issues to consider as you prepare to go into a mortgage decision? Obviously, interest rates and the APRs, the annual percentage rates, are very, very important. The credit rating of the mortgage purchaser is also extremely important. Property value, condition of the property. Are you going to have to put a lot of money into the property to bring it up to par, to the level where you can either live in it, or you can rent it, or you can flip it, whatever it is that you're going to do. You need to take a look at the property value and the condition of that property and any additional funding that you may need in order to bring it up to code. Property location is very important. And it's not only looking at the location in your immediate area, but also to take a helicopter view and start to consider what's happening in that general vicinity. Within a mile, one square radius mile. What is happening? Are there any hospitals coming in? Are there any major shopping centers that are being built? Any universities, any schools, depending on what it is that you're trying to do. If you want to be someone that's going to be renting properties out, these are things that would be very critical. If you're someone that wants to live in that homestead and make it your homestead, then obviously these things are important, because it could very well determine the outcome of those property values in the future. The person who's buying the property, what's their propensity to consume? Some people are spenders, others are savers. What are you if you're entertaining in purchasing a 50 and 30-year mortgage? And you'll see why that will come into play in the next few minutes. Are you committed or involved to a savings program? Whenever I have this type of conversation with a client, the first question I get asked is, well, Bert, what's the difference between being committed or being involved? And the analogy that I use is a funny one, but it brings home the point that we're trying to make. Most of us have had bacon and eggs for breakfast. Now, in a bacon and eggs breakfast, the chicken was involved, but the pig was committed. So again, when it comes to a savings program, if you're truly committed to what it is that you're trying to do from a savings perspective, then you have a total commitment and you're not going to deviate. If you're involved, you may deviate if no longer fits what it is that you're trying to do. I rather work, especially when we're doing 30-year mortgages, with people that are committed to building wealth and not just creating a reduction in mortgage payments. The other thing is, and this is difficult to acquire, is having some basic understanding of economic principles. You would be surprised. I deal with clients that make a lot of money. I deal with business owners that make a lot of money and have a lot of wealth. But although they make a lot of money, they have no understanding of how money works, and many of them are making major mistakes and will make major mistakes in the future that will impact the estate planning of their family members at some point in time. Also, the income tax status. Where are you? Where are you living? Are you in a state where you're going to have not only federal income taxes but also state income taxes and local taxes? Obviously, living in Florida, we don't have to worry about the state income tax or local income tax, but we do pay federal income taxes, obviously, from that perspective. So let's go ahead and do a comparison between a 30-year mortgage and a 15-year mortgage. So let's look at a 30-year mortgage. The value of the property is $450,000. Down payment is 20%, so that equals $90,000. Fixed interest rate on a 30-year mortgage is 4.4%. And total payments, including escrow, would be $2,717. Now, out of the $2,717, $1,803 will go toward P&I, principal and interest. $848 will go toward taxes, and $67 will go toward insurance. At the end of 15 years, on this 30-year mortgage, there's still a principal remainder of $237,000, a little bit just north of that. Total interest paid at the end of 15 years, and I'm using 15 years to do a comparison to a 15-year mortgage. Total interest paid would be just north of $202,000. And the total interest that would be paid had this individual stay on that mortgage for 30 years would be $288,000 in interest payments. Now, when we flip the coin and go to a 15-year mortgage, again, we still have the $450,000 property value, the $90,000, which represents the 20% down payment. The interest rate is lower. The 30-year mortgage has a 4.4% interest rate. The fixed interest rate on a 15-year mortgage is 3.75. And the reason for that is simple. The bank is willing to reduce the interest rate payment because they're going to get their money back quicker, and they're going to be able to flip those dollars again into additional mortgages or credit cards or whatever it is that the banking industry does. There's an interesting conversation that we will have on another podcast, and it deals with the fractional reserves, which almost drove the vast majority of banks in the United States to bankruptcy in 2008. And although that was the case, hundreds of banks went bankrupt in 2008 because of their overwhelming differential in their fractional reserve calculations. So those are things that are very, very important for all of us to be able to understand from a business perspective. So these are things that we'll talk about a little bit more. Now, obviously, the payment, including the escrow, is higher, is $3,734 as opposed to $2,717. And when we break down that $3,534 payment, $2,620 goes to principal and interest. $848 goes to taxes, and $67 goes to insurance. So it's the same as on the 30-year mortgage. Now, at the end of 15 years, the property is paid for, and through 15 years of interest payments, the 15-year mortgage has a much lower interest, total volume of interest, which now sits at just north of $111,000. Now, when you sit down to make this decision, most of the people that I engage prior to them reaching out to us, they're making a microscopic mortgage view in order to make a decision. And they make the decision from a microscopic perspective. And what do I mean by that? Well, they're going to take a look at the interest that would be paid on a 30-year mortgage, the total interest, which is almost $289,000. They're going to take the interest that would be paid on a 15-year mortgage, which would be just north of $111,000, and the interest payment difference, in other words, the arbitrage between the interest paid on the 30-year mortgage and the 15-year mortgage, it's a whopping $177,000. And obviously the property is paid off after the 15th year. So from that perspective, you say, well, this is a no-brainer. It does make all the sense in the world to purchase a 15-year mortgage if I can afford to pay for it versus a 30-year mortgage. But now, as the famous radio announcer used to say many, many years ago, Paul Harvey, he would always tell a story and then he would say, and now the rest of the story. So what we're going to do now is we're going to take a look at those same two mortgage scenarios, but instead of looking at them through a microscope, we're going to look at them through a telescope. And the reason for that is very simple as well. When you look at your finances and your financial decision process through a telescope, you're going to be able to see the entire financial world, or your entire financial world, right in front of you. You're going to be able to find out if the decision that you're making on one side of the ledger has either a positive or a negative impact on the other side of the ledger. So let's take a look at it from this perspective as well, because we have already looked on the volume of interest that is paid, and that one makes sense, for you to choose a 15-year mortgage versus a 30-year mortgage. But now let's look at the telescopic view of the actual mortgage payments. So the 15-year mortgage has a mortgage payment toward principal and interest of $2,620. The 30-year mortgage has a principal and interest payment of $1,803. So the difference in the arbitrage between the two principal and interest mortgage payments is $817. The big question now, and this is why I asked whether the property purchaser was either committed or involved, or were they savers or spenders, is because if you understand the economics of what we're about to talk about, then you may give consideration to a 30-year mortgage versus a 15-year mortgage. So let's say that we take those $817 per month. So every year you're looking at $9,804. And then we start a savings program. Now the savings program can be placed in many different investments. You can invest it in mutual funds. You can invest it in annuities, depending on your age at the time that the property is purchased. You can purchase a 7702 plan. You can invest in a Roth IRA, again, depending on your age and when do you want to execute that potential payoff. So there are a number of things that you can do. But let's say that we're investing, for argument's sake, the $9,804 in an investment vehicle that would average somewhere around 6%. Now, some years may be higher, some years may be lower, but let's say using a linear return, and I know the market doesn't work that way, but for this exercise, just bear with me. We're going to use a linear return of 6%. And if you do that every single year for 15 years, at the end of 15 years, you would have an account value with $251,000, actually almost $252,000. Now, if you would remember, when you purchased that 30-year mortgage, if you would have made that choice, at the end of 15 years, you have a property or principal remaining value of $237,000. But now, at the end of 15 years, you have a separate account where you have almost $252,000. Now you can have choices, and the more choices you have as you start to invest for the long term, the better off you would be. So let's say now you're in year 15. You're doing fairly well financially. You're enjoying the tax deductions that you're getting from this mortgage because it's lowering your adjustable gross income. So therefore, you can now determine, especially if you're married, between you and your spouse, whether does it make sense, for us to pay the mortgage off, because you could just write a check out of this account and pay the mortgage off and have the same benefit and get the deed in your hands at the end of 15 years, although you had a 30-year mortgage. But you may decide not to because it may not be economically feasible, or it would make economic sense for you at that point in time, depending on many different issues that you may or may not have any control over. So that's a choice. Maybe you want to wait a year, you might want to wait 2 years, 3 years, whatever that may be. You may just want to continue to put those $9,804 away every single year and use it as a supplemental retirement plan or a retirement plan for you and your family in the future. So you're now killing multiple birds in one shot. You're saving for retirement, and you started saving from retirement from year one of your mortgage payments, and you're also paying down the property as you go along. Now, if you continue to make those investments and you don't decide to pay off the property and you want to have it run through the 30-year period, then at the end of 30 years, you would have your property paid for, plus you would have an additional account value based on the investments that you made from year one that would be equal and or exceed $831,000. Now, if you had put that money into a Roth 401k or a Roth IRA or a Roth or a 7702 plan, obviously that money now would be readily available for you for retirement purposes, investment purposes, and then those money would be totally tax-free to you and your family. Now, the reason why I'm asking you to always look at the economics and to look at your decision-making process through a telescope as opposed to a microscope is that, life gets in the way often. And many times when life gets in the way, it's not necessarily for our betterment and for the good of mankind. What happens if you're 5 years into either one of the mortgages and you suffer a job loss and you can't find a job? I had a couple of clients years ago that moved to Silicon Valley because they were into technology. And they both, husband and wife, lost their jobs. And they lost their home during the dot-com failure. Now, just to give you another anecdote on these same clients, they were actually sending 1 or 2 extra payments every year. They had had the mortgages for about 8 years, and they had been sending an extra 1 to 2 payments, sometimes 3 payments, to hopefully reduce the property or the mortgage from 30 years to about 17 to 18 years. Well, when they both lost their jobs, they couldn't find any jobs in Silicon Valley. Most important, they couldn't sell the properties because the property values were plummeting. If they went to the bank and said, look, I've been prepaying my mortgage and I just lost my job and my spouse also lost his or her job, would you give us a break for the next 6 months to a year of not having to pay your mortgage payment every single month because of the fact that we're so far ahead of what we intended to do when we purchased a 30-year mortgage? What do you think the bank would have said to you? What do you think the bank said to my clients? You see, when you're qualifying for a mortgage, is not they look at your assets, but mostly they look at your ability to pay. And when you don't have a job, you don't have the ability to pay. And if you don't have the ability to pay, you're not going to be able to close on that property. And eventually, my clients were foreclosed on the property, and obviously the rest is history. What if you suffer a disability and you're no longer able to work, or you're disabled for, a year to 2 years? Obviously I've been in my business for almost 30 years, so I have had a number of clients that have had disability claims. Some have been fairly short, maybe 6 months to a year. Others have been a longer disability, 2 to 3 years, maybe 5 years. I have 2 clients that are lifetime disability, and gladly they were able to purchase, when they were doing well, disability policies to age 65. So they thank me every single day for me to be able to have provided and to protect them from that potential risk of living with a disability. But disability can destroy. Now, if you have a little bit of money, what's better? Do you think it's easier to pay, a principal payment of, or actually a mortgage payment of $3,534, or one that is $2,700? So what we try to get our clients to do is to take their equity out of their property as quickly as possible. What if the property values drop? Obviously that could become a concern. And when property values drop, the first person that loses is you, the property owner, because your equity is the first one to go away. And we'll talk a little bit about that. What if you are going through a divorce? What if you have family emergencies? So again, those are things that most of us fail to think about as we are preparing for making mortgage decisions, but we fail to understand that whatever decision we're going to make is going to have either a positive or a negative impact along those lines. Now, let's talk a little bit about mortgage leverage, and let's talk about equity position, mortgage position, and leverage position. Now, when it comes to the equity position in a mortgage, the one question I always ask my clients is, what's the rate of return on the equity on your home? And usually they'll say, well, Bert, if my home is appreciating by, 5 to 6% a year, the average has always been about 3%, but there are times when it goes up quite a bit, other times when it goes down quite a bit as well. Then obviously my equity is increasing by the same amount. And my argument and the answer that I give my clients all the time is that the rate of return on equity is always zero. And the reason why it's always zero is because your property value your property is going to increase in value or decrease in value whether you have a mortgage on the property or not. So it has nothing to do with the equity in the property. So you want to try to get as much of your equity out of your home as you possibly can. Now, had those clients in Silicon Valley, had they, instead of prepaying that mortgage for a number of years, for 8 years, had they taken that those additional payments and put it into a separate account, at least they would have had some leverage. Maybe they would have been able to pay the mortgage a little longer. Maybe they would have been able to find other options that were not suitable to them because of the decision that they made. Now, mortgage position, the lender, for the most part, it's always ahead of the curve. By the way, the payments that you're making on your mortgage to the bank is an asset to the financial institution. The payments that you're making is a liability to you. So the banks are always going to be on the right-hand side of the ledger where you may be on the left-hand. By the way, once you get into the leveraging position, here's what is critical to understand. The more equity that you have in a piece of property, the less leverage that you have. And the reason for that is the more equity there is in a property, if something were to happen and life gets in the way, the bank is going to usually foreclose on those properties that have the higher equity. Why? Because they can turn around, they can immediately sell it or dump it in the market, and they're able to get their money back plus a percentage of that equity. So the only time that a business owner or a property owner is actually leveraged to his or her favor is when you're either 100% amortized, so you have no equity whatsoever in the property, or when your property is totally paid for. But then, unless you sell it, there you may have no other way out, because if you lose your job, even if your property is paid for, you're still going to have to pay for maintenance and taxes and insurance and so forth, and that may become a major issue to you. Now, tax leverage, it's one of the areas that I do calculations for my clients as they sit to look at mortgage payments. So we're going to look at mortgage interest, mortgage payments, and provisional income calculations, which most of you that join us and join me on these podcasts every week, you know a little bit more about than most of the people that you visit with. Now, mortgage interest, it's important because it's one of the few deductions that work in your favor. There's a good debt and there's a bad debt. If you can deduct the interest that you pay to service a debt on an annual basis from your income taxes, that becomes a good debt because it reduces your AGI, which is your adjustable gross income. Now, mortgage payments, one of the interesting things on 30-year mortgage versus a 15-year mortgage is that the longer you pay into the mortgage, the easier it becomes to make that mortgage payment. Let me give you an example. When I first purchased my first home was back in 1983, and because I'm a U.S. Marine, when I purchased my home, I used a VA loan, and I only had to put 5% down. So my mortgage payment was fairly high. I was paying $764 mortgage back in 1983. I'll never forget my first home and the first mortgage payment that I ever did. Now it's a 30-year fixed mortgage, paying $764. It was not an easy payment to make. I would argue that at that time, $764 was on the high end of the mortgage payments for the people that were in the standard of living that I was used to at that point in time. Now, fast forward 35 years. If you had a mortgage payment today of $764, how good would that be? It would be perfect. And the reason for that is that inflation caught up to all the mortgage payments. So my dollars in the future are going to have more leverage than they do today, than they did back in 1983. So making a $764 payment 20 years later after 1983 was a lot better than making them in 1983, because I was getting pay raises. Financially, I was doing a lot better, and then obviously inflation was working on my favor. And then obviously the provisional income calculation, where you need to be careful, is that many times, having a mortgage payment and having to pay interest may benefit you when it comes to retirement distribution planning, because once you do your provisional income calculation, we're not going to get into that today, you will have a reduced adjustable gross income, or reduced AGI. You're going to be able to keep your Social Security benefits under your thresholds, and you're going to be able to keep your qualified plan distributions under the same thresholds, and therefore you may be able to generate Social Security benefits and qualified plan distributions out of your 401ks and IRAs without having to pay any federal income taxes on that money, because of the fact that you have standard deduction, and or if you itemize deduction because you have other expenses that are deductible, including your mortgage expenses, may be a benefit to you from a business perspective. Final thoughts that I want to bring to your attention. The bottom line is that mortgage decisions cannot be made in a vacuum. The other thing to consider is that you can borrow money to fund a mortgage. You can borrow to fund an education if you need to, but you can't borrow to fund a retirement plan. Now you may say, well, Bert, after the 15 years and after I paid for my 15-year mortgage, I can start saving at that point in time. The answer is yes, but it's 15 years later, so you're going to have to accelerate your contributions to try to catch up to somebody who's been saving from day one on the 30-year mortgage. Because at the end of the day, you want to make certain that when you get to your retirement, that you have a successful retirement and that you don't run out of money before you run out of life. So my call to action to all of you today, it's always simple, is the fact that the definition of insanity is doing the same thing over and over again and expecting a different result. So one of the things that I encourage each and every one of you as you listen to my podcast, and many of you do reach out to me, and I thank you for that, and many of you have become clients of our firm, and we thank you for your trust and your loyalty to us, is to reach out to us to see if you can qualify for customized tax-preferred retirement blueprint, because we're going to take a lot of these decision-making processes that you're going to be making either today, tomorrow, or in the future, and we're going to plug them in for you into our tax-preferred retirement blueprint to make certain that you're always making the right decision for yourself and your family. So if you're interested in reaching out to us and to me personally, please feel free to call me at area code 786-1042. You can also email me. I'll give you 2 email addresses. The first one is a little bit more complex because it's my corporate email address, and that would be Bert, B-E-R-T .Salazar, S-A-L-A-Z-A-R, at CambridgeFPLLC.com. Cambridge F as in Frank, P as in Paul, LLC.com. Bert.salazar@CambridgeFPLLC.com. You can also email me at my personal email address, which is Bert, B-E-R-T, at bertsalazar.com. And most important, please feel free to check our website. We have all kinds of good information for all of you. And that would be at www.CambridgeF, as in Frank, P as in Paul, LLC.com. And as I always end every single podcast, remember, my goal and that of my firm is to kind of help all of you to change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thank you so much for giving us a little bit of your time today, and we'll talk again next week. And thank you for being a loyal group of individuals that are listening to our podcast and that have reached our 50th podcast milestone. So again, thank you, and we'll talk again next week.